Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is May 15th, 2025. And today on our call, we have back the team, Gord Reykdal and Barret Reykdal from Everyday People Financial. Everyday People Financial trades on the TSX Venture Exchange under the symbol EPF, and it also trades on the OTC under EPF-CF. The company is currently trading at 76 cents with about 126 million shares outstanding, or about a $95.5 or $96 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Gord, great to have you back. We love to have companies back shortly after they post financials, which you just recently did. So we've got you here to give us as much of an update as you can on Everyday People. Before we do that, though, for those that are kind of new to the story, maybe refresh everybody's memory and gives people an idea of what Everyday People Financial is all about.
Sounds great. So I'll give you a quick, thanks a lot, Paul, appreciate it. And just give everybody some background on Gord Reykdal. I'm one of the co-founders of the company. We have three current co-CEOs in the business. And we have the company is basically structured with two pillars, one on which is a base of collection agencies, which we refer to as revenue cycle management. And then our financial services business that has a host of financial services and products that we provide for, a lot of them on the card products, and overall the company is structured and whereby we have both separately managed and then adding value from both sides of that. So the company itself, I think it's important to note, I always bring this up when I talk to shareholders for the first time as well. Like, the company and management have a lot of invested capital in the company. Myself and my family, we have over $21 million of our hard cash put in the company. And that's not by way of capitalizing wages or anything. I haven't taken a wage, nor has Barret, for nearly 2 years. And so we're really invested in line with the shareholders. I converted the last portion of my debt, or my family's debt, in January at 82 cents and $1.10 respectively, for the last $6 million. So yes, we've got operations throughout the UK on the revenue cycle management side of it, and in Canada. And then we've got the financial services predominantly in Canada. So a quick overview. We reported a couple of weeks ago our year-end results. We had a $57 million or 51% increase in revenue year over year. Good solid performance overall, and really building the business. We've now just released our Q1 financial numbers, again with some very strong financial performance and growth overall. The company just had under $18 million in revenue over the quarter, just under the prior year was just under $15 million. So good growth, good 20% growth year over year. And the company is certainly on track to continue with that type of build on not only the revenue, but also on the bottom line. Our adjusted EBITDA for the quarter was basically just under $2.1 million and growing. And we've now provided segmented information in our MD&A that helps break it down. So we've got some transparency around the two basically pillars, financial services and RCM, and how they're growing. We're certainly, the business itself, we've taken down some more debt in the company overall. So at the end of the day, the company will be sitting with a fairly modest debt load of about $8.5 or $8.6 million once we finish off with the remaining of our EP Homes transition model to the board payment program. And with the conversion of a debt that took place in January, so we're lessening that interest expense as well going forward. That was part in the quarter. So overall, we're pleased with the overall performance. We did put a press release out in December that we're adding a significant additional base to our client base, to our RCM business, and we've still yet to realize on 40% of that gain. So just to highlight some numbers, For the quarter, our revenue for revenue cycle management was $15 million, so $60 million annualized. So then we take that 40% number, and that's approximate, but we'll be pretty close to it. That'll add another 24 million or thereabouts into our revenue stream. And our EBITDA margin was a little bit better than 15% for the quarter on the revenue cycle management side of the business. So you can see that by the end of the year, we should be close to that mid 80 mark, between 80 and 85 million run rate in revenue for RCM. And we expect our margins to move up from the 15-16% we currently reported this quarter, bringing that number up closer to a 20% contribution margin. So that's a pretty hefty add to the company overall, and with no increase in costs, that's why our margin's going to go up. And we've got two major contracts that we've onboarded so far, one with Volkswagen, and collectively those contracts are just basically under 10 million pounds sterling a year for the ad. And then we've added other contracts with Desjardins in Canada and multiple other ones with the Canadian Tire and things moving forward. So we expect that number to move forward. So to give you a little bit of a preview on where we're going with respect to our business on that side of it. So very solid. We're obviously still looking at acquisitions as well, but nothing definitive at this stage. So those can be adds to that number. So you can see where we're going with the company very clearly. And then with the financial services side of the business, what we expect there, we've got multiple products that we have underneath our financial services platform. One of them is our HSA card. We signed an agreement with a large Alberta corporation that has over 300,000 consumers that are employees. And just to give the audience a little bit of a better understanding, the HSA is a healthcare spending card. It's a proprietary platform that we've developed that allows employees to make healthcare spending purchases without coming out of pocket and then waiting for the reimbursement of funds, which is problematic because in Canada, nearly 50% of the Canadian population right now, they're living paycheck to paycheck. They can't afford to come out $500, $300 for eyewear and wait for that reimbursement. So what's happening is they're not utilizing the programs, which is, from an employer's perspective, is the highest basic retention tool that you can actually get in the marketplace. And there's currently right now between 7 and 8 million Canadians, employed Canadians, that have healthcare benefits under the old archaic structure and model. So we're bringing that forward now. We're starting to execute that with companies. I mean, our revenue stream off that is we get paid a fee from the employer that could range anywhere, including the interchange fee, from 2 to 5%, and depending what the annual spend is. So if you're using $2,000 a year, it could be $40 to $100 per employee. So lots of room, no capital required for us to build that, which is great. So we just started now working on rolling that out. One of our other larger programs under financial services relates to, we took that same platform, which is, again, it's a design program for healthcare spending with certain restrictions. So you can't use it in an ATM, you can't use it at a liquor store, or you can't use it at a casino. So we've got those restrictions. We took that platform and presented that to the Alberta government, saying, look, there's a opportunity here, because right now the Alberta government provides to the tune of about $5 billion a year to Albertans to help them subsidize their living. And so from a standpoint of that occurring, we said, you're doing right now through a check deposit or a direct deposit to the customer's account. We can provide it for the government to be provided on a card. So we can do this on a card, so they, again, restrict where it's being used and going forward. And we make basically a 1% interchange off that whole transaction. So the potential upside would be like, on 5 billion would be roughly about $50 million in fees off the province of Alberta. But we can expand that. We've been greenlit to start a pilot project that's underway. We haven't got any other numbers I can share you through right now, but we've got the process starting, which is a big thing. And then moving forward from there. And then we have other programs like our borrowed down payment program, helping getting Canadians into homes that we've worked a very unique structure, which is balance sheet neutral for us, but helps get consumers into homes. And then EP supply chain, which helps companies in the supply chain network that we profit from in sharing in profits with them, but do not directly provide any capital, of course. So that's all capital light, invest from our perspective and all fee generated. So on the financial services side, over the next 12 months, we expect to bring in, call it $6 million in EBITDA contribution off that. So you take the revenue cycle management, you take, by Q4, say if you use $1.5 million run rate, we're moving the numbers up. Our $6 million annualized run rate, 1.5 for the quarter. You're moving up some pretty decent numbers here that we're shaping up for the company, and that require no additional capital to drive this. And one point I'd like to make that helps resonate with really what our business model is all fees for services. We don't make 1 penny from the customer. The customer pays nothing. So we're there, we're aligned. So even on the revenue cycle management side of it, we collect money, but we only get paid on a contingency basis. But our efforts are aligned with the consumers, because if they pay, then we get paid. So the one interesting stat that we've done in this business model in the UK is actually we take on clients, and we deal for a lot of blue chip clients in the UK and in Canada. So when we bring the clients on, we put them onto our platform, and these are AI assisted programs where we go into the open banking, we determine their affordability assessment before we set a payment arrangement. But we also help educate the consumer on financial literacy and actually how they can actually pay their bills on time and get themselves back and reestablished. So the staggering point of that one is that we have a 92% success rate of consumers that pay their bills on time once they come onto our platform. And we built a book in the UK that's about 150 million pounds in arrangement books. It's off balance sheet. It's not our money, but in there we have 30% of that is our embedded fees. So we've got basically half our revenue already accounted for through a payment arrangement book that basically consists of a 92% success rate on payments. So we're bringing that platform to Canada that Barret will be actually helping implement. He's now the co-CEO for the revenue cycle management in North America, bringing that forward. And that, coupled with respect to what we're doing on the financial services side, we'll be able to buy both pillars quite uniquely through 2025 and then onward, and continue to start building some value here for our shareholders. So that's basically it's more than an elevator pitch, but it's actually the update on the financials. But you can now tell you can certainly tell I'm excited about what we're doing, because I love what we're doing. We got a good team. These guys can execute. Tyler, the co-CEO for the financial services, he's a driver on the business side of it, and Barret and Graham on the RCM side of it. I get the luxury to brag about the results. They get to do all the work. So
I like that model. I like that model a lot. Awesome. Gord, that was fantastic. Thank you so much. Reminder, everybody, if you've got questions, I see a couple questions have come in, but if you've got a question for Gord and the team, just use the chat function and we'll get that done. I want to dial back a little bit. I remember when we had our first couple conversations, one of the really interesting things was how you're actually growing your business through M&A and some of the opportunities in the UK through acquisition there and whatnot. You've got some unique structures in how you sort of pay for these. Maybe let's talk a little bit about that.
Okay, so since you invited to talk about how we're growing, I got to put in one good point. This is very valid for our business overall, which I talked about earlier about our organic growth. So just to give you an example of organic growth, so we grow in two manners. The organic growth, so I'll give one of our longest standing companies. In 2019, we did 3.6 pounds sterling in revenue. In 2024, we did 10.5. That's a 200% annual growth rate for that 4-year period. So that's the most solid way to grow, because it doesn't cost us any money. And then the second way, through the acquisition side of it, is we uniquely structure our financing whereby we add huge accretion to the acquisition. And the way we do that is we rely on leverage. So what we do is we typically finance these with 60% bank financing, which if we're buying a company for 5 multiples, that 3 multiple is financed by bank. We'll take a 1 multiple or 20%, and that's financed by the vendors basically through an earnout formula that we just keep everybody honest. And we're not buying new companies here. Don't get me wrong, these are long-term established companies, but we still want to see their earnout. And so we stretch the earnout anywhere from 1 to 3 years on the earnout. So that's self-financed. And then one multiple or 1 turn or 20% is our equity. And historically, we funded the equity, even when the stock wasn't there, we funded the equity in our last 4 acquisitions at $1 per share. And so, we're continuing down that path. We've got it. So there's huge accretion for us as a company as a whole. But we're sticking to our formula. We're not going to overpay for anything. But that's a formula we believe we can add companies to our portfolio. And again, we've done 4 over the past 2 years. So we're actively out there looking. We're not running with hat in hand, or we're not indicating we're going to be telling people we're going to overpay. No, it's got to fit within our model. If it doesn't, move on to the next. And so that's what we're doing on that end of it. So those are some exciting things that we can add some value that will be significant plus ups for us overall as a company. Not predictable at this stage because we've got a pipeline, but we're working on it. And so we've done 4 in the past 2 years. Are we going to be able to get a couple done per year? I think that's highly probable. Yeah.
Let's talk a little bit about the project, I guess we'll call it, with Alberta and the health service product that you talked about.
Yep.
How far into it are you, and how big does that get for a company like you guys?
Okay, so the one thing with respect to the healthcare spending card, which is basically just giving you a little bit of a shot of it, but it's our private label MasterCard. I mean, we've spent a lot of money on that, but we did it for a reason, that we've got such a large market and an audience. So when you think about 6 to 7, or probably 7 to 8 million Canadians that, and these could be from Walmart employees to wherever it may be. It could be from wherever it may be. So the opportunity to be able to access that market is huge, because it's one of the it's an underutilized program because the model doesn't work because people can't come out of pocket. So do we believe we could get like a large number of clients? Yeah, we believe so. We're not going after, and we can do it small or large, because it doesn't really matter from our perspective if it's a 100 employee based company or 100,000. What we do is we afford the employers the ability to fund this as they want. They put their own framework around it. They put the rules in place. They control their spending, because as any company, everybody hates the fact that, hey, we got our benefits going up again next year. Well, how do you control that? Well, now we give the employer full control with online access through a portal that provides them, okay, you're going to spend X on here, here, and here. So you can critique this to any way you want, including discretionary spending. So the market's very broad. So I think that, we've got the ability to really, because of our flexibility and the uniqueness of what we're doing overall, we can really scale that up. So I think that, and we've got our sites working on a few larger companies. We've got a few companies that that we're working with right now that have significant employee bases, or that represent them in the several hundreds of thousands. So, and it doesn't take long even if you take the low side of what I was saying, if you take maybe 2 or 3% on a $2,000 spend, that's $40 per employee per year. You get 100,000 cards. That's a lot of money. So but the thing is, it's no cost to us, right? So you start adding up those types of numbers, and then once we get the data, and once we get something that we can actually share with our shareholders on, okay, here's what we've done and accomplished. We're not going to shoot ourselves in the foot from a competitive perspective, but we'll make sure that our shareholders know, how well we're doing on that. But the market's very large. So, I mean, I've got large expectations with respect to what we're going to be able to accomplish, because it's a good product, and it works out, very well for the employers. And in some cases, it could be much cheaper than what they're doing right now through their insurance companies, because they're paying them a fee. So I think there's opportunities here to build that. And then the takeoff from the Alberta government, we're successful on advancing what we're doing there. Well, Alberta is 10% of the Canadian population, approximately. Well, this would be good right across the board. So it would be something that we would be, get it right, get it going, but then take and replicate that across the country, because the same issues exist in other provinces as they would here. So we want to provide, government with the absolute transparency they need to manage the program properly. It'll probably help in reducing some of their administrative costs, but certainly give them better control of the flow of capital to ensure that it's being spent where it's been granted to be spent, and give them much more control. And the one thing I forgot to mention is we do it at zero cost to the government. We don't charge them a penny. So we make the 1% interchange from Visa. So it's an arrangement between Visa, ourselves, and the bank. That's how we get paid. So the government doesn't have to put up a penny for this. So it's a completely, so from a budgeting perspective or acceptance perspective within the government, having budgets and getting budgets approved for new projects are near impossible, if not impossible. But we're not, our proposition to the government is it's no cost. So, and we can deliver all of these things here. So I've got, again, I'm an optimist for sure. That's what helps drive the business. So I've got high expectations with respect to what we can actually, what the end result will be on that. And then it'll flourish once we get rolling. And I know the product stands on its own, but we know what we have here and what we built. So I'm quite confident we're going to be able to deliver some good results in a very large market. Like really, it's a very extremely large market on both sides.
And what's the timeline for something like this? What do you expect to?
Well, so so we've already started with the healthcare spending card now. So I would think and I'm not going to be overcommitting, but within the upcoming quarters, because it'll take like another probably quarter to really start getting everything put in place. But so should we be looking in Q3? I think that's a probable at least to provide some meaningful information and data. I would hope that we've got sometime between in Q3 we'll have the healthcare spending probably moving a little bit before healthcare spending, if that's a Q3 from a standpoint of rolling it out. But at least we'll have some data points and then things that we can talk about. But we'll make sure that we inform our shareholders with respect to what's going on. But it is all in the future. But when I go back and look, like say we've got the 80 to 85 million on revenue cycle management with a 20% margin, plus we've already got about a $6 million annualized baked in number in financial services, what we have right now. So we're sitting in a very, very enviable position because we're not sitting here. I'm not promoting and saying you got to buy the stock to get to. This is all going to be significant gravy for our shareholders as this comes to play. But so we're going as fast as practical. But we've got I believe a captive audience. We've got a good product. The product and pricing stands on its own. So I think we'll be very successful at it, and we've got the team that can execute upon it. So that's the key.
And Gord, I look at it a couple of different ways, but the economy, right? I mean, obviously, the economy fluctuates up and down, but what happens to your business in an up economy? What happens in a down economy?
So and having actually since I do this gray hair for a reason. So I've been through.
You have it, yeah.
But I've been through cycles of the ups and downs, and this business will do well in both environments. But when you look back historically, and this is typical for Canadian. I'm using Canadians as a base because I know of the UK market as well. But the number of 50% or thereabouts people living from paycheck to paycheck hasn't changed in probably 30 years, to be quite frank with you. So there's more there, there's more to spend, but it doesn't matter the cost of. There's things that happen that occur. So, but you're dealing with the broadest base of consumers, and then even from the collection side of it. Well, I mean, the collection side of it, in a very robust market, well, people lend more money. But doesn't mean people know and understand how to manage it. That's not going to change. So you'll do well in both markets. I mean, what we're experiencing now is probably, I would say there's a storm is brewing in Canada with respect to consumer debt. And we're in position A, if you're a golfer, I'm not, but anyway, position A with respect to where we would consider ourselves being. And then that sort of falls into also the financial services side of it, because, if people are having difficulties, managing day to day, even more so our products become more valuable and more needed. So it's covering on both sides. And again, the whole key, and not the whole key, the big strength in our business is we don't charge our customers nothing. So there's not a business that I can think of that is all fee for service, but we don't charge our customers nothing. So that's a strength. So, it's the people that have basically, that really, if on the collection side of it, that advanced it, they're the ones that are paying us. So, which is fantastic. And the other, it's all through merchants or other merchants primary that are making the money, our employers, but they're taking care of their employees. So all the things are aligned properly so that we're not sitting there with one dependent factor, I mean, the economy goes up or down, we're not going to see a change from our perspective. And speaking that from experience, I know the business and the industry from a lending perspective. My background, I have been in that for quite a few years, and so I know the ups and downs. And I think that we're well positioned. That's part of the whole model, that we wanted to put a company in place that actually can provide for Canadians and people in the UK and the markets we're in, provide a financial service that's not out there and not necessarily attainable by a lot of people, whether it be the collection side of it, helping them get back on their feet. No one's doing that in Canada. We're certainly doing it in the UK and doing a good job at it. And then same thing for the financial services products overall, giving them access to these products enhances their lifestyle. So.
Perfect. All good. Okay, let's jump on some questions that have come in here. And it looks like a handful of questions here from Curtis. He says, how much credit line is currently available for the company? Or maybe a better way to say it is, how much liquidity does the company have?
So, okay, we don't even have a credit line. So we have, so the company itself, we've got lines for acquisitions, but we don't need capital otherwise, because we don't require any capital. So the company's liquidity, because we've been growing, we've been investing, but we've also been paying down a lot of debt. Paid down $10 million of the debt in the in calendar 2024, and then we've also reduced our debt by about 1.6 million in Q1. So we're sitting, our cash balance is about the same where it was in December, 1.6, 1.7 million. So we're going to see our cash build Q2, Q3, Q4 onward. So we're not looking for any credit facilities at all for the company. So we don't need any.
Yeah, perfect. And like I said earlier, or you said rather, when you structure these acquisitions, most of the money is being sort of project funded through VTPs or whatnot. So
yeah, they're all self-funded. We will not do an acquisition where we have to require capital to be funded from another part of the business. It's got to stand on its own. Otherwise, in my view, we're overpaying for it and we won't buy it.
Yeah, perfect. Okay, next question from Curtis is, in June 2025, I see $4 million in debt is due. Will there be a press release if this is financed or paid off? How do you communicate what you're going to do with that $4 million in debt?
Yeah, so what that was related to an acquisition that we did in one of the acquisitions, the RCM side of the business in Canada. So we are going to be, because right now that's sitting in short-term liabilities, we're going to be refinancing that and moving that out. But we don't expect that to be anything more than just in our note disclosure normal course. So yeah.
Okay. Yeah. Gotcha. Yeah. So it'll go from short-term liability, long-term liability, and reside. Yeah.
Exactly. Yeah.
Gotcha. Okay. Question number 3, gross profit percentage was 64.7% compared to 70.9% in 2024. Do you expect this metric to increase or decrease throughout 2025?
So we expect to increase, and that's why we put in the press release about the additional 40% base increase in the RCM side of it. So that's going to be our most significant material add to the quarter over quarter, which is going to have a positive impact on a financial performance, B cash, and C margins. So yeah.
Gotcha. Okay, next question around G&A. How much will G&A and other operating expenses grow in 2025? He says, I see roughly 2.25 million growth from December 2024. This could have materially helped the bottom line.
So, and Dill, our CFO, is on as well too, but our G&A, we don't anticipate any material change. The only thing that I would say, and Dill can jump in if there's anything I'm missing, but the only thing that really changed there is our audit fees that we've increased, and that's probably been the real only material increase in G&A that occurred in 2024. But we don't see that not going up. If anything, maybe we can shave that down a little in 2025. And Dill, I don't know if you had anything else that maybe you'd want to add.
Yeah, I think one other comment I can add there is that the other reason for the increase in 2025 you probably see is that there was an acquisition that was completed in Q4 of last year, and and which the G&A expenses we're starting to record in this quarter, right? And so that's why there's an increase in G&A expenses based from the acquisitions.
Yeah, that makes sense.
Thank you.
Perfect. Thanks, Dill. Okay, another question. Okay, will each quarter be profitable going forward or lumpy? Maybe let's talk about that, because there does seem to have been some volatility in the numbers here over the last couple of quarters. And certainly Q4, that's not unusual, because usually you get the kitchen sink is sort of thrown into the audit. But maybe give us an idea of what you expect lumpiness wise going forward.
So, okay, I can speak to that. So in 2024 is the best way to do first. So we had some changes in our accounting policies on some of the revenue recognition that caused that lumpiness, but it was non-cash that skewed the numbers. And then we're seeing that actually, I mean, everything basically, back in line 25 and starting that process. So our SG&A, the costs that are in the MD&A, just going backwards, the corporate costs aren't going to change materially, may come down a little bit. We're going to eliminate that interest expense, because we got interest expense there on the $6 million for myself, for my company for 1 month in that. EP Homes we're eliminating, and that's on a wind down anyway. So that'll be basically, when that's gone, that's gone. Revenue cycle management, we will see some very, very consistent numbers and increases in numbers as we have with respect to that going forward. So you should be able to, because it's a very predictable business, we'll get now start adding a growth month quarter over quarter. You will see that consistency there. So that's going to be a large driver of the entities, or the combined performance. And then the financial services, again, sorry, that's which basically there was some I'll call it some lumpiness with respect to that, because the first quarter of last year we had $1.3 million in adjusted EBITDA, as opposed to 436. Pardon me, EBITDA of 1.365 versus 458 in 2025, and that related to the change primarily in our revenue recognition policy, where we've basically gone to for EP supply chain, basically cash accounting. So it's so that will continue to be now consistent going forward, and that's what I was mentioning over the next from Q2 going forward. We'll have around $6 million coming in. It should be a progressive climb to basically $1.5 million, $2 million in Q4, but it'll build up to that. But over the course of a four, we'll bring in roughly about $6 million income on that pillar, the services pillar, plus whatever added from aging. So
Gotcha. So the next question is around deferred revenue. Maybe before I ask it, where do you get your deferred revenue from?
I'm going to turn that to Dill.
Mm-hmm.
Yeah, so I see that question, and that's I think that needs some clarification on deferred revenue, because there's no I guess on our balance sheet there's no deferred revenue that we've recorded, and I think if I'm not sure if this question is related to that change in the accounting policy that Gord just mentioned, related to EP supply chain.
Okay.
And it seems like from what it is this question is the exact is what Gord mentioned is related to
change in accounting.
Policy.
Because what we did, we had this in our Q4 press release in our year-end release, is that we had $6.4 million, 3.8 of it that was recognized in the first 3 quarters, and then the policy change occurred in Q4, of which, if it didn't occur, we would have actually recorded $6.4 million in revenue, and which is all basically bottom line in Q4. But that revenue, the revenue for Q4, pardon me, we basically changed the policy whereby we're just recognizing, we will be recognizing it going forward as cash is collected. So it's sort of a short term, like a 2-week bad news story that we had to reverse it. but now we got to bring that money back in into income.
Mhm.
So but it was all non-cash, and we tried to be as descriptive as possible that, it's basically an accounting change, not a business change, and there was no write down of assets or receivables or anything
Mhm.
else, and because it's not even set up as a deferred revenue or anything, period. Now, as we collect, we bring it in, and in the quarter, we collected in Q1, we collected around, what was the deal, around 550 grand or something like that, that came in the quarter or something like
That's
that.
correct. That's correct.
Yeah. So
Gotcha.
we'll let that build up, and then future periods we'll be
I
adding
got
that
it. So
in.
it'll sort of show up and get recognized over
Yeah.
a few quarters here. Yeah.
Yeah. It was just a more conservative approach, and
Yeah.
it is what it is, and then but that's
Yeah.
But we knew we were releasing our Q1 right away, so we felt
Understood. Yeah. Perfect.
natural.
Okay. Is the company currently in a position to acquire? I think we sort of said yes. What is the what is the total addressable market for acquisition targets, and how many of the companies are in the pipeline? Can you speak to that?
So
Yeah.
we would have about 10 companies in basically in our sites. We're working on a few of them. But when I look at the UK marketplace overall, the market size is about in revenue about 2.1 billion pounds. Very fragmented. The largest player is 16%. They're a debt purchaser. Then 11, and then the most recognizable player is a 5% market share, and the rest is fairly fragmented. There's 13,000 employees in the industry in the UK, so big market for us to acquire and lots of opportunity there. And then in Canada, and not the same size, but I mean, just to give you relative numbers there. So in Canada, it's about just under $850 million market size for Canada. And there's over 297 businesses in Canada that operate in the debt collection services business. And basically, they're all basically up for sale, I'm sure, at the right price. But we're going to be select. But we're going to introduce our UK methodology into the platform. But we want to start acquiring in Canada. I mean, I don't know if it'll be this year, beginning of next, but it's imminent, but around the corner anyway. So yeah, lots of opportunities. So
it's a target-rich environment, in other words. Yeah.
Yep. Yeah, very much so. Yeah.
Yeah. Excellent.
And we're select, so we're careful too. So.
Yeah. And is there a size that sort of is
well,
appealing?
The last acquisition we did with CCS in November, I mean, that company's producing about 11, 20 Canadian a year in revenue, good margin, good EBITDA margin. So those are probably, would be ideal. There's some larger ones out there, but we want to be cautious, but so that would be sort of, I would consider sort of on the right size. And that was we borrowed roughly about $4 million to purchase that, Canadian dollars. It's 2.6 million pounds. And that's a similar size that we did the other acquisitions in Canada. That's what we borrowed from RBC. So similar type of numbers. Those are pretty easy for us to absorb and integrate into our company. Yeah, but there's certainly no shortage of market, acquisition opportunities out there. So, but we want the seasoned businesses though.
Yeah. If you were to look at 5 years, like what do you think conceivably in call it a normal environment you'd be able to grow to with that through acquisition?
So, I mean, thank God Graham's not on the call right now, but he would probably, and Barret is, but so if you just look at our growth, like we went from 13 million to 60, call it, in a 4-year period, can we take that 60 and make it 250 in another 4 years? I think highly probable. Like if you think of our run rate right now, just on what we're doing, so we're going to be in the mid 80s. You add another, we're going to be, we'll be, call it, at a run rate by the end of the year without any acquisitions, it will be in the mid 90s or at a run rate anyway. So you think about that going forward, can we take that number and move that to double or triple in a 4-year period? I'd say yeah, we highly probable that we can do that. The organic growth story is going to add a lot to on its own. We'll just keep adding new clients and building it, and then the acquisitions will follow. But I think can we do better than that? Probably, but I mean, I think that's a pretty realistic number if you just look historically where we came from and where we're at now. I mean, that's pretty decent growth, but
Mhm.
that's what we're all about. They're chew gum and walk at the same time. We've got good infrastructure in place. You've got good, strong people. We've got a good structure overall from an acquisition perspective, to on the integration side of it. So we can make that full, but that's probably a realistic number. So if you take that, you'd even need to take 250 out and at a 20% margin, you're talking a $50 million EBITDA company. And today's at least the comps that we're aware of, I mean, they trade anywhere from three and a half to 3.7 times multiple on revenue. They're predominantly debt purchasers, but that's a close public comps we have. But so there's lots of room there to grow. Like we have a lot of value to be generating and creating here. And but we've got a good system down. There's a lot of experience, and we want to continue to focus on building that shareholder value.
Perfect. What are the challenges the business is facing? What sort of keeps you and the team up at night?
Well, as I mentioned, I think that the biggest thing that from our perspective overall is all execution. Like if you look on the revenue cycle management side of it, well, the only way we get paid is if we perform. So that all boils down to execution. So you get awarded debt, you're able to acquire new clients through good solid performance. So it's the continuation of the performance, the execution, which is monitored very frequently. And then same thing for the financial services side of it. Well, by and large, everything's done now. It's all execution. So those are the things where the focus is really execution. So are there any other contributing factors out there that could trip us up doing that? I'm saying not, because we've got everything now laid up for us. Just do our job and execute, and then we'll win. But because there's nothing saying, oh, we need this much money to run those days are gone. We don't need any more money. We're now spinning off profit and making cash. So those are things, a lot of challenges for business and a growing business. So we can then, keeping the discipline on the acquisition strategy, you'll never get yourself in trouble there if you maintain that, which we will. So it's all execution, to be honest with you. So it's not, there's not worries. It's actually, set the bar, and I keep raising the bar. So
awesome. Yeah. Of all the sort of initiatives that the company's got going on right now, what gets you, Gord, the most excited?
So to be frank with you, like I play a role on the acquisition side, but with Graham's experience and Barrett's experience, that one there, I can spend less of my time there. Not that I'm not excited about it, but it's on the other products and services where I get quite excited about that, because once they start to resonate, and like even of the programs you talk about, you need one of those, and those are massive company makers. So like, I mean, so those are the ones that have me the most excited about where the will be. I know what it takes, but that's really what gets me excited, to be frank with you. And then, and as the company develops, we want to create, depending on what takes place with the share price. But I mean, if it's not good, we'll certainly put a normal course issuer bid in. We'll do things like that. But ultimately, we want to see the company as a dividend paying company, because you're never going to use your capital to, if you're going to borrow bank money at 4 or 5 or 6%, you're never going to use your cash to do acquisitions. That's not going to happen. You may use it for your equity portion. That's going to be a small part, but really going forward, create that dividend paying company that really, you can set your watch to it with predictability of, the performance that's really going to be behind that. That's what I want to see, really happen to the company. And I'm not getting younger, but still I got lots of energy, but we want to get this thing rolling where, it's not too far down the road, we start seeing those dividend checks rolling. So I'm excited about that, to be frank with you. So.
Absolutely, it should be.
Yeah.
The share price is certainly a lot firmer than it was, say, a year ago. You've got more investors calling you, no doubt. But what, if anything, are investors getting wrong about the business? What do you want to make sure that they really understand?
So I think to be frank with you, two things, that we've got a lot of stuff going on in our company. So I think that there's sometimes it's difficult for people to get their head around it overall, but we're trying to break that down the best we can to keep it, the revenue cycle management, the collection agencies, and provide all the disclosure on that. And then understanding what that alone itself is worth. Like if we were to apply a multiple to the comps out there, well, we'd be trading at 250 or whatever number share right now, or close to it. So but that's okay, because we're just getting rolling. So we're not in a foot race. We don't need to, we're not going raising any money. We're not in a foot race to do anything there. And then from a standpoint of the financial services side of it, we've got some things happening there. I'm not even saying that should be your value at anything of any, but I think it maybe confuses a little bit of where where the key drivers are in the company, I think. But the focal point should be around at this stage around the revenue cycle management and the financial performance, because that's something too from a valuation perspective, a comp that people can tie their head around their value, and we'll continue to break down that information the best we can so that we want to be very transparent with what we're doing and where we're going. But that's probably the biggest area. But we're still new though too, Paul. Like I mean, up until January, some people never even heard of our company. So
absolutely, yeah. No, that's changing. Good.
Yeah.
So advice for us investors paying attention to the business right now. What do you think are the catalysts or metrics we should pay the most attention to?
So I mean, I think two things. I mean, really breaking down from a standpoint of the RCM revenue, which we do break down, and the EBITDA on the RCM on the RCM side of it, and then also on the financial services. For corporate expenses, they're not going to go anywhere, but we disclose them anyway, just to make sure everybody knows what's there. And then EP Homes, I wouldn't put any weight on revenue or earnings or lack thereof on that end of it, because we pivoted and changed that to a different model, but we're still disclosing it, so we got complete transparency around it. So it's a continuation of the revenue build on both those lines, obviously. And and then basically the catalysts are going to be the increase in probably onboarding new clients. We've got most of those clients on board right now that we talked about in the 40% number. And then any of the significant milestones with respect to the launching of the products, once we can get some meaningful information out to our shareholders on that, on the financial services side, that'll be something else that that should be monitored or watched, because that'll be meaningful for the company, because that business is all margin for us, and we have no cost capital. It's all margin. So the acquisitions will speak for themselves, because we'll define that and disclose a lot. But the organic growth is a key indicator as well in the business, how well the business is doing. Because again, that's what's driving your bottom line with no investment and no further investment, pardon me. So those are the key things, to be keeping your eye on. So, which, we're comfortable we're going to deliver on that. So, yeah.
Fantastic. Gord, this has been great. Is there anything that we missed? And if not, what's the key message you want to make sure everybody walks away with today?
Well, I think we covered off a fair amount, and I'm very passionate about what we do as an organization overall, and I think it's just to appreciate all the shareholder support, and our objective here is to increase shareholder value, where we are all fully aligned. We have 35% of the company is including my family and our management. It's a big number. So we're certainly aligned and focused on delivering that and increasing that shareholder value. So just we'll continue to deliver. We'll create a little bit more exposure around the company, and I'm quite confident that if we focus on the business, the market will take care of itself, and I think that we'll get rewarded for it at some point.
Absolutely. Well said. Business first, and everything takes care of itself. We've been speaking with CEO or Chairman Gord Reykdal of Everyday People Financial. Also Dill and Barret, thank you for joining us today. If anybody wants more information, what's the best way to approach you guys?
I tell you, our direct contact information is the best. I mean, you know, you can contact us anytime. It's gord@epfinancial.ca, Barret@epfinancial.ca, Dill@epfinancial.ca. We provide direct access, and we allow direct access at any time. Any shareholder, of course, can email us, and we'll get back to you. We're very responsive, so just feel free to reach out. And Graham's email, he's in the UK. But if anybody, any of your listeners or your members are in the UK, we can connect you directly with Graham's email address. Barret, I think it's graham.franken at
epomail.uk.co, I believe. I'm sorry.
correct. Yeah, it's okay. But we can connect. So if anybody, they can go through me or Barret or Dill, and we can provide access. And then also Tyler, who is away getting married now in Spain, or probably in Italy, he would be on the call otherwise. But Tyler at epfinancial.ca as well. Yeah, all of us are accessible at any point in time.
Fantastic. Tyler, I'm shocked that he would rather go and get married in Italy rather than hang out with us today. Shocked.
Well, I invited him, but I got a negative response. So
awesome. Guys, thank you so much for joining us. Look forward to the next time we can catch up.
Thank you. Have a good night.
Thank you so much.
Awesome.
Take care.
Thanks,
Bye.
guys. Bye for now.
Bye. Bye.